now let's get into the good stuff. So we're going to talk about U.S. sales tax today for those of you who we are assuming are generally uninformed about what to expect in the U.S. Now, you've probably heard horror stories about U.S. sales tax, how it works, what to expect, things like that. This is really going to be a definitive starter for many of you out there to help identify what you need to do going forward and what some of the pitfalls are in terms of selling into the US as a non-US business. The session today is not going to be anything that is legally binding in terms of tax advice, but we just want you to understand what you can expect when you go start trading in the US and some of the tax implications that you're going to run into, okay? There's many challenges with expanding in the US, right? You got to deal with localization, dealing with foreign currency or, other logistics providers out there within your e-commerce system. Many things, many boxes you have to tick when you're trading in the US. Specifically, I want everyone to understand here today that the US tax authorities have been increasingly aggressive in terms of non-US businesses trading in the US border. There's a 2017 figure from the GAO, which is the Government Accountability Office, that estimated that state and local governments were missing out on about $13 billion in tax revenue. That's sales tax revenue. We're not talking about income tax, payroll tax, corporation tax, things like that. It's purely on the indirect tax that is US sales tax. Now, the reason we're giving you a 2017 statistic is that in the years since 2017, a lot has changed, and a lot of states have gotten a lot more aggressive in terms of how they're trying to recoup that estimated $13 billion in taxes, okay? US sales tax is inherently complex. There is no federal sales tax. So like here in the UK, we've got, the HMRC, creating legislation around VAT compliance. It's not up to the individual counties and cities to control how the VAT is levied and monitored. But in the US, it's a lot different. There is no central authority. And so it's all governed by the state and local jurisdictions. And so what you have ultimately is a union of 50 small countries, each with their own tax law. Okay, so there's not like a federal sales tax you're going to deal with. If you're registering in California or Indiana, you're going to be dealing with California and Indiana individually, filing different returns, adhering to their reporting requirements, and doing anything they ask really as a registered taxpayer. Now, because there's no centralized system, what it's resulted in is that within the states, counties, cities, jurisdictions within the cities create their own taxes as well. And so what you have is, as Alistair mentioned, in excess of 12,000 different taxing jurisdictions across the US. Within those 12,000 or so jurisdictions, there's about 35,000 different tax rates for products, services, rentals, and the like. Okay, so very, very complex. And the more states you end up, dealing with, registering in and opening up a store there or whatever the case may be, the complexity increases exponentially. So it's pretty wild. But for those of you who are visual learners like myself, I like seeing nice, pretty pictures. So just to kind of reiterate here, sales tax is a lot like VAT in the sense that it is a tax that is levied on the sale of a taxable product or service. The biggest difference between VAT and U.S. sales tax is that sales tax is not levied throughout the supply chain, right? So here you've got in Europe, you've got the concept of input VAT and output VAT. That doesn't exist in the US. If you're in the middle of a supply chain and you're selling on to a distributor, reseller, manufacturer, you're not going to be charging sales tax in that scenario. You're not going to be recovering sales tax either. You're just going to exempt most of those transactions. That's the biggest difference between VAT and sales tax. Today, there are 45 states plus the District of Columbia. District of Columbia is not a state, it's a federal district, but for the purposes of sales tax, you look at it as a state. So technically there's 46. 12,000 jurisdictions, as I mentioned already, 35,000 rates within those jurisdictions. And there are a few states that we call the nomad states that do not have sales tax. So they are New Hampshire, Oregon, Montana, Alaska, and Delaware. Now, while those 5 states don't have sales tax, it's not as simple as it may seem on the surface, right? So if you look at a state like Oregon, they've got a separate tax for the sale of bicycles, okay? New Hampshire doesn't have sales tax, but they do tax beer, wine, and spirits, okay? So there's still consumption tax just on a very narrow group of product or services. Alaska is certainly, a kind of a caveat to this list as well, because while the state doesn't have a sales tax, the municipalities or boroughs, as they're referred to in Alaska, do have sales tax. So the state doesn't, but Anchorage, Alaska does, right? And there are many cities within boroughs within Alaska that do have sales tax, even though the state does not. So even though you might think you don't have an obligation in these states, depending on what you sell and how you sell it and where you're based, you may in fact have a reporting obligation, even in those nomad states, okay? Now, again, I'm a visual learner, so I like presenting pretty pictures to my audiences, and I think this map is really fascinating. And this is not meant to be some kind of scare tactic, but this is a map of the U.S., of course. You probably recognize many of these states and perhaps cities as well. Every color on this map represents a different tax rate. So you can see that there are some states which are seemingly pretty simple, right? Nebraska right there in the heartland in the middle. They've got a few tax rates you have to deal with. So if you're registered in Nebraska, you're probably not having too much complexity in finding the right rates. Whereas if you're in one of the more populous states, look at California out there on the West Coast, Texas down kind of south central of the map there, Alabama, New York, right? The more people you have in the state, generally speaking, the more complexity, right? Because when you have more people, you've got a higher tax base. More tax base means more bureaucracy inherently means more complexity. And then so depending on the state you're in, you might be having a really easy time with sales tax, or you might be having a very complex time, difficult time with sales tax compliance. And as a foreign business, sometimes dealing with these states can be incredibly, incredibly challenging. I do want to zoom in on this map a little bit here. And what I'm going to do here is show you a little place within the city of Denver, little city, if you will. It's called Commerce City. And Commerce City has a few different tax rates within it. And it just so happens that on this street here, 2 next door neighbors actually have a different tax rate. Okay, so at 7450 Leiden Street, you've got a 9.25% rate, and 7452, you have a 4.75% rate. Now, if you look at the differences between the makeup of those tax rates, right, you got a state, county, city, couple special jurisdictions. The 9.25% house there does fall within Commerce City limits. And the one on the right, the 4.75, you'll see that Commerce City is missing from that jurisdictional breakout. So they're just outside city limits, but that means about a 4.5% rate difference between the two taxes that they pay. So if you are someone who is using zip code rates, postcode rate files today to look up rates in the US for your customers, you're probably not getting it right. In about 2/3 of the instances, you're going to be charging sales tax incorrect. So there's a very common misconception in the US that all I have to do is look at the postcode and I can get a tax rate. Well, you might have a place like Colorado, California, Texas, Florida, Washington State, where you've got 2, 3, 4, 5 different tax rates within a single zip code. And so it becomes very, very challenging in some of those states. In some states, you're fine, right? If you're dealing with a flat rate state, then you don't have to worry about it because every zip code is going to be the same. But in some of the bigger states, where you have more bureaucracy, more complexity, zip code rates aren't going to be accurate. So there's this concept in U.S. sales tax compliance that if you haven't heard of it today, you absolutely will when you start speaking with a tax advisor or some kind of attorney to figure out where your obligations rest in the U.S. Now, the concept is called nexus, and nexus is really just a fancy way of saying a connection between your business and a tax authority. Okay, and that connection, that sales tax nexus there, can be triggered by a bunch of different things. We're going to go into those in a second. But ultimately, if you have nexus in one of these states, you have a legal obligation to register for sales tax, okay? Give them all the necessary paperwork. Once you get your tax ID number back from the state, you have to calculate sales tax, charge sales tax on every sale you make in that state that is taxable. And then every month or every quarter, every year, sometimes if you're lucky, you have an obligation to then report those taxes, right? Just like you get a non-resident VAT number here in Europe because you open up a warehouse, you sell through Amazon, you breach a distance selling threshold. Same idea in the US, but you're only doing it at the state level versus the country level, okay? There's as I alluded to earlier, there's a lot that's happened in the last kind of 3 years or so around US sales tax compliance. And the biggest trigger of this has been what's called the Wayfair decision. Formerly, it's called Wayfair Inc. versus the state of South Dakota. But it was a monumental Supreme Court decision that really opened the floodgates to states being more aggressive in how they collect sales tax from businesses who are not within their state borders. So all of a sudden, California is getting sales tax permits from people in Brazil, in New York, in Canada, Argentina, and all these foreign businesses all of a sudden have to register in California and deal with California sales tax, okay? And that's called economic nexus. So it's a presence in the state purely based on your economic activity. Okay. Now, on top of that, before we get too far into economic nexus, when you think of nexus, you think of warehouses, stores, employees, all of these things that historically are pretty obvious signs that you have a sales tax requirement. So, hiring a remote sales team, for example, to go out and sell in different regions. Everyone knows typically that's something that triggers sales tax. Of course, storing inventory in a warehouse, whether it's something you own or it's an Amazon warehouse, that kind of thing. But there's more nuanced and kind of specific nexus laws on the books out there that are very state specific. There's something called click-through nexus, where if you have a marketing partner, maybe that's an Instagram influencer, right? You've got a model who's promoting bikinis or shirts or whatever you sell, and they're based out in LA or New York, as most models are, and they're driving traffic to your site. Their presence in that state as a marketing presence, as a sales presence, can trigger a tax obligation, even if they're not on your payroll as a full-time employee, because you're giving them commission or flat fee or whatever the structure is. In the eyes of the state, they see that as nexus, right? And in some instances, that will trigger a tax collection requirement. So for many retailers based in the UK, for example, or in Germany who sell in the US, oftentimes that marketing is driven from folks in the US, and that can trigger tax reporting obligation in that state. In some places like Texas, selling software itself triggers nexus. So if you just sell a SaaS product, or you deliver, you're old school and you deliver software on CDs, or I don't know how many people still do that, but if you are selling software in the state of Texas, as of 2014, they consider that something that automatically triggers a tax reporting requirement. It automatically triggers nexus. Web cookies, in a couple of states, placing that small file on a customer's computer, tablet, whatever it might be, to save their passwords and their preferences and things like that, that's been deemed to trigger a tax collection obligation as well. States are getting increasingly aggressive, so they've created, some states, larger states typically, have created what's called nexus discovery teams, where they literally pay people to go out there and go on e-commerce websites and load up a shopping cart and see if sales tax has been charged or not, and whether the business should be registered there. They've requested trade show attendee lists. Of course, this is pre-COVID, but they've requested trade show attendee lists saying, hey, you know what? You had a conference with 500 people. Give us the names of attendees so we can go after them and see if their business is registered or not. And they've also started adopting technology to go after businesses and see who's registered and who's not as well. So all this to say that in June 2018, the world of sales tax was kind of flipped on its head. So the concept of distance selling thresholds, as we understand here in Europe as retailers, was pretty foreign to the US until 2 years ago. The US governments, state governments, basically looked over at Europe and said, hey, they got this cool concept of distance selling, right? Of registration requirements based on economic activity alone. Let's try to mimic that. And they fought for years to try to get this legalized. And it finally did in 2018. And the first state to do it was South Dakota. And they said, hey, if you're not based in South Dakota, you could be based anywhere in the world. But if you have more than $100,000 of sales into South Dakota, or 200 unique transactions, okay, you have a legal obligation to register for South Dakota sales tax. Most states after that kind of copied and pasted South Dakota's legislation. They said, hey, that's a good idea. 100,000 is reasonable, provides a kind of shelter for smaller businesses. But once they get that 100,000 threshold, they're big enough that we want their tax dollars. And applies to all different sales types. So whether you sell online, offline, whatever your sales model is, catalog, right, phone orders, that kind of thing. It applies to everything. So you have to look at your sales by state now and determine whether or not you have a collection requirement. States fell like dominoes, right? So it was at first it was a trickle of states. All of a sudden, you're looking at most states nowadays that have some kind of economic legislation, economic nexus legislation on the books. Generally speaking, these thresholds are about 100 grand. There are a few states, namely New York and California, where their threshold's much higher. So they provide more shelter for smaller businesses, saying don't register until you get to $500,000 in sales. And then there's Kansas, who doesn't really care and took kind of the opposite approach, it seems like. And they said, you know what, our threshold's $0. Deal with it, right? So pretty much everyone's got to register in Kansas. It's being fought in the courts, but ultimately, it ranges from $0 to about $500,000, with most states being around $100,000 or $200,000 as a threshold. Okay. Now, again, visual guy here. So I'm going to give you another pretty map. The blue states here, as you would probably guess, are states where there is economic nexus. So if you remember the nomad states from earlier, Oregon, Montana, right? They don't have sales tax, and thus there's no economic nexus. Missouri and Florida are the two holdouts that have sales tax, but don't have economic nexus yet. I imagine that will change given the trends we're seeing, but it remains to be seen. And that the idea here, the message you should be kind of taking home is that most of the states that you're going to sell into are going to have economic nexus. You just have to look at the thresholds. Okay. So once you get registered in the state, you're all of a sudden dealing with another problem, which is product taxability. I've taken this example of New York. New York is notorious for taxability problems. But if you look at something like a bicycle, shower cap, walking boots, sweatbands, these are all taxable, right? It's tangible property. It's used for consumption. It's argued that it's a novelty and you don't really need something like this. And so they're going to tax it. On the other hand, the non-taxable products are similar, and one could argue they're in the same category and that they may not be necessary, who knows. But ski gloves, gardening gloves, right? Swimming caps, shoulder pads for American football, right? That kind of thing. Those are all non-taxable, okay? New York's just one example. If you look at a place like Florida, window washing, right? It's taxable if you get it washed on the inside of the business, but not on the outside of the window, right? One's a janitorial service, one's a maintenance service. So Florida deems that as taxable versus exempt. There's reduced rates for guacamole in about 6 states, but not regular avocados. Not sure why, but if you buy pre-packaged guacamole, it's a different rate than if you were to make a guacamole yourself, right? So sometimes there's seemingly no rhyme or reason behind a lot of these rules, but that's what they are, and as traders, you've got to deal with that. So you've got Nexus. You know that there's problems with tax rates. Now what do you have to do? Okay, so we put together this checklist, right? And this is a pretty high-level checklist. This is something you're always going to want to, chat with a tax advisor about, just to make sure you don't leave any stone unturned. But first things first is register where you're required to, right? Look at your economic activity. Don't just look at that though. Look at, where do you have remote employees, whether they're full-time or contractors, that can trigger tax obligations, right? Do you have referral partners driving traffic to your site, bloggers, influencers, whatever the case may be? Figure out what the correct product taxability is, right? So if you're selling clothing in Minnesota doesn't tax clothing because they deem it as a necessary product, okay? Whereas in New York, clothing is taxable, but only when it's over $110, okay? So identify what you sell, how it should be treated, okay? You don't have to know every last rate, but at a high level, understand, is it taxable or is it not? I mentioned this already, but look at where you have warehouse locations. Do you have referral partners, remote employees? Have your sales team gone out and gone to a trade show? Not recently, but in the past, of course, kind of pre-2020. And when we do go forward and things go back to normal and these, in-person events start picking back up again, figure out, perhaps if that attendance, even if it might just be for 1 or 2 days, figure out if that attendance triggers a tax registration requirement. Historical liability is a big one. This is often something that businesses miss, is that when you go to register, they're going to ask you when your tax point started, right? When did your liability begin? And you can't just say, oh, it started tomorrow. If you've been selling in that state for years, right? If you've been trading in the US for 5 years and you tell them you've only been selling there for 2 weeks, first off, you're perjuring yourself on a legal document, which is no good. Nobody wants that. But second off is that they can then come after you with fines and penalties and things like that, which we'll talk about in a minute. Have a plan in place to monitor your activity going forward. Okay, so have a way to track and see, okay, we're sending these people to this state, or what's our revenue. But ongoing compliance is a big one. You can't just get all caught up and then ignore the upcoming stuff that's ultimately going to rear its ugly head. You want to make sure you've got a plan going forward in terms of your tax compliance. Figure out how you're going to manage your filings, because when you're registered in 10 states, potentially you're dealing with 10 different filings every single month. So who's going to manage that within the organization? Are you going to look at software, or are you going to have a tax advisor do it for you? Payments as well. Filing is one part of it, but actually giving money to the states is very important as well. They want their money. Their coffers are looking pretty dry recently with the economic downturn. So very, very important to make sure you manage payments efficiently as well. Now, all of this stuff, for lack of a better term, is important because the risk of getting it wrong can be incredibly high. Based on some surveys we've taken, is that the average cost, audit cost, for kind of a mid-market SMB type of organization is generally about $100,000. And that includes penalties, interest, tax advisory fees, attorney fees, and simply lost productivity, which is hard to measure, but lost productivity is a big one. It's kind of a gray number. So this could range, right? The audit could only cost you $80,000, or it might be $150 or $200. Really just depends. But for a mid-market company, $100,000 is a lot of money. Okay, and the state penalties themselves for non-compliance range anywhere from 10% to 50%. My home state of Washington is very, very aggressive and has been known to penalize companies around 40, 45% in some instances. States can introduce liens on your inventory, right? So if you're holding something in a warehouse, they can seize your inventory, sell it off at auction to recoup the taxes that you didn't pay them, and they have the legal authority to do that. And simply put, manual compliance is something that you're going to spend a lot of time on, and when you introduce the human error to all of this, your risk goes up exponentially. Okay, so always good to look at how you can supplement your workload with technology and automate as much as you can when it comes to the U.S. and any other country for that matter. Okay, so talking about automation, I'm going to give kind of an elevator pitch, if you will, maybe an extended elevator pitch on Avalara's technology and how it kind of fits into your workflow and what you can use it for in terms of managing U.S. sales tax compliance and beyond, right? We'll touch a little bit on global requirements as well. So first off is the core product, which is AvaTax, which is, if you're in the retail space, you may or may not be familiar with, but it does the sales tax calculations and VAT, customs duties, right? It's a global tax engine, but ultimately it plugs into the systems you're already using. So if you're running a Magento site, a Shopify site, or you've got NetSuite or SAP on the back end, there are connectors out there that make the implementation and usage of AvaTax fairly straightforward, okay? But it's gonna provide real-time tax calculation for your global sales, okay? We look at invoice information, transaction information from a checkout, right, from an e-commerce basket, provide real-time tax calculation for you to then charge your customer. With that information, what you can also do is manage exemption certificates. So as I mentioned earlier, is that if you're sitting in the middle of a supply chain, I don't imagine many people on this presentation are, but if you are or have a kind of a sister company that is, you can manage your exemption certificates with Avalara CertCapture. It's a separate product, but it is tightly integrated with the AvaTax solution. And that way you're able to retrieve certificates from your exempt customers. You can store them, track them, request new ones when the ones you have on file are expired. So it's a very useful tool because ultimately those documents become kind of your insurance policy when you get audited. Now, after you've collected the certificates and you've calculated tax correctly, you can use the AvaTax product to file your ongoing sales tax and Canadian GST returns. So we store copies of your transactions, just the financial information, and we use that to fill out your tax forms digitally, submit them online, manage payments for you as well. So it really is an end-to-end solution from that initial tax rate estimate when a customer loads up their shopping cart on your website, or if you're creating a quote in your ERP, sales order document, all the way to the tax notices that you're ultimately going to receive from the states. Avalara manages all of that for you. Okay. What's also included in AvaTax is the ability to track your economic nexus activity. So we will look at states where you're currently not registered in and tell you if you are getting close to the threshold or if you've actually breached the threshold. It doesn't start charging sales tax automatically. We still want you to go out and register. You can use us to do that. There's a little link at the bottom that allows you to purchase registrations online without having to call someone. So it's a very, very useful tool to allow you to monitor your activity on an ongoing basis. What you can also do is use us for other sort of tax advisory services. So if you wanted like a nexus study for us to look at what your activity is, what your operations look like state by state, and whether or not that triggers a registration requirement, we can absolutely do that. Talked about registrations already. We've got a team that can register you in the US, in Canada, wherever you need. We do voluntary disclosures. So if you've got, you've been trading in the US for 10 years and you've kind of ignored this, up until recently, we can approach the states on your behalf anonymously and tell them that we've got a taxpayer who owes you money and we want to negotiate the penalties down to give you the best deal as the retailer. And all sorts of other auxiliary services that come around US sales tax advice. As a global company, we not only deal with the US, but we do have teams who can register you in new countries outside of the US. So if you need someone to deal with your South African returns or your German returns, Italian, right? Any country where you don't have the ability to register and file yourself, we've got a team based out here in the UK who are able to manage your ongoing compliance through a managed service. So that's an option as well for some customers who need it.